Okay, now with this section of the program, we are going to focus very heavily on data, and that's via the economic calendar. You can go to the likes of Forex Factory, FX Street. If you're with a platform already, they're going to have a calendar attached as well. It's important to really understand the data that's being released every day. You know, as always, I mentioned when you are looking for a career within stockbroking, it's not just what's on the actual um, template or the pitch that you've been given, or the script, should I say. It is down to yourself to really build pictures for investors, understand where the market's going to be going, understand where the economy is going, as that will dictate which way investor sentiment will weigh. So use all the information and all the slides, and more importantly, bring it forward to your investors, make them aware of what's coming out daily, how that data has been digested by investors, and what they could possibly do moving forward by way of trade ideas, strategies, and so forth, as this is going to be a key component of you being a successful stockbroker. Okay, now we're going to focus very heavily on some of the key components of the economic calendar, and the sort of data that's going to be released. So when we talk about the overall calendar and the significance for yourself, especially if you're on the broking floor and you are speaking to investors, be fully aware you need to be putting strategies and scenarios into your clients' minds in order for them to visualize what you're talking about. They need to have a sense that you know which direction this market could potentially go, as well as you needing to understand data to back up some of your trade ideas. Okay, so we use economic calendars as a essential tool for really assessing health, performance, and understanding and identifying trends within the overall economy. That's not just here in the UK, that's globally, US, Europe as well. And in all fairness, we will tend to focus more on US data than UK data, because whatever happens over in the US and China in particular naturally has ramifications for us. So it will provide us with valuable insight into various aspects of the economy, whether that be growth, inflation, employment, unemployment, consumer spending, as well as international trade. But one thing is it can also be characterized into different areas, okay, and those different areas tend to be the likes of the leading, lagging, and coincident indicators. When we talk about leading indicators, these indicators are used to predominantly forecast future trends. Okay, they're there to provide early signals and potential shifts in economic conditions. So that could be consumer confidence figures, it could be building permit figures, as well as manufacturing figures. Now, you know, whichever data you look at, most of the data, if you read it accurately and you put it all together, that naturally gives you an overall trajectory on which way you feel the market could go. But we've broken it down, and it's important that you do understand, especially if you are looking to take your examinations as well. They do quiz you quite heavily on leading, lagging indicators as well. When we talk about lagging indicators, again, it's within the name, really. This is data and indicators that have already, based on events that have already happened. Okay, it's there a lot of the time just to confirm trends. So when we look at it, we look at unemployment rates as well as inflation. They tend to be good examples of lagging indicators. Corporate profits you could put there, especially if it's within earnings seasons. And the final one is coincident indicators. These indicators really provide a real-time view of economic conditions. It does confirm the current state of the economy. Okay, so there tends to be GDP figures, retail sales, employment levels, average wage growth as well. So they will naturally be split up into different areas. But the key area I want you to focus on is going to be understanding and assessing impact of data. Now, there's always three colors. There's always red, orange, and yellow, no matter what website you go on to. Okay, we tend to use Forex Factory calendars. You can use FX Street. You can use, if you're trading and investing, they will have their own as well. A lot of the time, they will have these very simple colors attached to it. Now, the colors are just used to indicate the potential impact and significance of upcoming economic events or data. And I use the word events because it's not just data that's released or seen on an economic calendar. It is also individual speaking. It could be heads of central banks speaking. It could be FOMC members. It could be prime ministers and presidents speaking. The reason why they appear on the calendar is due to the fact that whatever does come out of his or her mouth can have an impact on the way people see the overall economy going, and in turn will um, allow you to adjust how you feel to invest, whether you're continuing long, whether you're short, whether you're still focusing on speculation, or whether you want to more focus on diversification. So you want to be not only looking at the data, but understanding what words are coming out. So when we talk about red, any event or data released with red associated with it typically focuses on very high importance and high impact on financial markets. Okay, it will have a significant influence on market sentiment, volatility, and trading activity. Now, anyone that's traded would clearly know is if you got your trading screen and you're looking at um, an economic calendar and a release has come out, such as non-farms, for example, you will naturally tend to see a big shift, especially within currency markets, very quickly at the time of that information being released. Okay, it does take. It reacts very similarly with the stock market as well, but maybe not in such an aggressive fashion. It's all dependent on how people view the data. But again, red data is very significant. You don't want to be trading before or just after that data because it is a very volatile space. Same as if you are speaking to the investors, you want to make them very aware of, timings. So, ma'am, look, if we are looking to focus on short-term elements of trading, we keep a very close eye on data. We never trade directly before or directly after data release, especially if it's of market significance and high impact. Okay, so those are the things you want to make your client aware of, that you are in tune with what's happening in the market, and they feel reassured that you're on top of whatever's coming out. Anything that's orange typically focuses on medium importance or moderate impact on the financial markets. Now, in my experience, even medium data can be of, you know, considerable significance. We do still see, huge fluctuations, predominantly within the currency market. Maybe not massively reflected on the equity markets, but it is something we keep a very close eye on, as it does still have a significant influence. And then finally, you've got yellow mark data. This is of low importance and of very low impact on financial markets, which is absolutely fine. Um, it's not going to be of huge significance, but it's worth knowing a lot of the data that does come out at this time. But yeah, those are the three main colors you want to focus on. Now, that's understanding it. Now, if we're talking from a broker standpoint, and your aim is to, remember, bring on board clients and investors, there's never a three-call process anymore. The process to onboard investors takes a little bit longer, may require meetings and multiple follow-up calls. But one way of going about it and actually having a considerable impact is always keeping up to date and informing your clients of data that's just been released. Okay, but not only just telling them data is released, but maybe put some strategy and story behind it. You could call them and very easily say, like, non-farm data has come out considerably better than expected. They were expecting 170,000 jobs created. There was over 250,000 jobs created. Average wage growth figures have notched up a fraction of a percent as well. So not only more people are being employed, but the average wage growth within the US is, that bit higher. So it's, effective wage growth and effective employment. That will naturally spur central banks to want to lower interest rates, because not only is the economy improving, inflation is coming down. So there is that more confidence within central banks to lower interest rates. If that is the case to be, investor sentiment would be that much higher. we could potentially see US markets, S&P, go and hit all-time highs, and if not surpass that once again. That will have a big impact for us here in the UK, especially if you're focusing predominantly on the FTSE 100. As we know, over 70% of the companies within the FTSE 100 are US denominated stocks. Okay, so sentiment will be great. It would be a good opportunity to potentially get involved in the markets now and benefit from a potential rally that could ensue. So that's one way of going about it, and always paint the pictures. A client may be in a situation where they say, I don't know which way this market's going. You know, a lot of the time they will call up and say, I don't know which way this market's going. Well, clearly we do. You know, investors, you got to remember, investors will base their decisions whether to buy or sell something not only based on um, the strength of an individual company, but also the overall economy. It's zero point me buying stock which looks fundamentally good if we're going into a recession or the market is going to collapse. Okay, there's no significance. So you've got to be in a position where you are not only selecting stocks based upon their overall position, how well they stack up fundamentally, how well they stack up against their competitors, but also how well are they doing within the sector they are in, as well as knowing which way is the economy going. Is the economy improving in that turn? The markets will potentially improve as well. I'll make the distinction: the economy and the stock market is not aligned. Be fully aware of that. But of course, investment decisions are based around which way we see global economies going. Last thing we need is a recession, and we're actively buying stock of something which is very high beta. So yeah, so just bear that very much in mind. And if they do say, I don't know which way the market's going, highlight the fact, look at the data that's released. Okay, if data continues to be positive, they may be stuck in a very negative mind frame, which is hampering their decision making. Okay, sometimes you need a second set of eyes and ears on the market and on their portfolio in order to help them. So always go back, pick up the phone, read off the data and what can potentially happen. Or if the market is going to come back, absolutely fine. Data does indicate um, you know, less people are being employed, more claims for unemployment, inflation is creeping up, more people are moving their stocks and investing in the bond market, which is seen as a safe haven. It could be the catalyst for maybe a market pullback. Absolutely fine. We may want to be in a position where we look to profit take. We may be in a position where we want to implement index shorts. These are the options that we have on the table for you. Okay, and always package it as you best feel fit. But the key important is just to understand the data and how well our clients will take that on board. Okay, what you will find in an economic calendar, first and foremost, economic indicators. As I mentioned earlier, traders, investors, a lot of economists will look and analyze the data really to stay informed of important events or any form of data releases that will impact financial markets and the overall economy. Central bank meetings. These are scheduled meetings and decisions of central banks regarding interest rates and any other form of monetary policy. So again, very vital information to have in mind. Certain economic calendars will show corporate earnings reports, or at least release dates for major publications or any publicly traded companies that will be reporting. So that's one thing to keep a very close eye on. Government reports. These are naturally employment reports, trade balances, and retail figures. As and mentioned in my previous slides, speeches and events. Scheduled speeches involving policymakers from the FOMC, for example, central bankers, head of central banks, and any other influential figure that may provide insight into economic and financial conditions. So presidents, prime ministers. So that's what really to expect from an economic calendar. Okay, we're going to now focus on just breaking down a lot of the key reasons why calendars and data are significant to yourself, predominantly if you are working as a broker, if you are looking to get into the industry and really focus on the sales aspect, as well as if you are a trader, you want to keep a close eye on data, as it will back up a lot of your trade ideas, as well as help with entry and exit points. So when we talk about market expectations, the calendar naturally helps investors, traders anticipate and manage market expectations by really focusing on important economic data. So that can be central bank data, that can be GDP figures, employment reports, and so forth. So when you know when these events are occurring or scheduled to take place, you can then forecast for what could potentially happen, and you can adjust your investment decisions, position sizes, and so forth. And I will come on to volatility management in a second, but um, when you are speaking to clients, and as I mentioned in our previous slide, they will naturally have concerns about the market and which way the market is going to be going. The only way you can really either back up those claims or have contrary views is by whatever the data is coming out, because whichever way you look at it, big investment banks, big all central bank decisions will be based on data that's released. So expectations is heavily weighted on the data, and that's naturally where you will find a lot of the reasonings for convincing investors to get on board now or take advantage of certain market climates. Okay, and when we talk about volatility management, um, again, data will help you prepare for any potential market moving events. That can be the likes of non-farms, that can be GDP, that could be interest rate decisions. So, I've always been a keen believer that, even if you are trading, for example, you would want to look at the data before looking at your charting, because charting can go completely out of the window if market moving data does hit the market. you know Traders will react very quickly, and you can be in and out of a position, stopped out of a position very quickly, just by focusing on a chart and not really appreciating the volume that's going through it. So volatility management becomes a very crucial role during periods of heightened uncertainty or market sensitivity. So economic data is very vital. You want to make it very clear to the clients that you're speaking to, or the prospects, that if you are focusing on the short-term elements of the market, you are keeping an active eye on data. You're not looking to react unless important data come out and markets have already reacted to it. Okay. Next is decision making. Now, economic data is an aid for all of us, whether as traders, businesses, policymakers, as these events will impact asset prices, market sentiment, as well as any other factors. So investors really do use economic calendars to make informed decisions. And as mentioned in my previous 2 points, when you are speaking to a client, make them aware any form of decision making that you are looking to go through, whether you're looking to bring a trade to the table, you have taken into account data that's released and data that can help back up your idea. Because if I'm looking to go long of the FTSE 100, for example, and I'm taking more of a weekly view on it, I want to make sure that the data that's already being released, or the data that's potentially coming out or forecasted to come out, is going to be in our favor. The last thing I want to do is go long of the FTSE 100 when we've had the US non-farm payrolls worse than expected, average wage growth worse than expected, consumer confidence worse than expected. That's not going to add a great deal of stimulus or a great deal of backing to my decisions. But if I was to come out and say, look, we are going to be going long of X based on global data coming in better than expected, investors are more than likely to say, yeah, you know what, that seems like a great idea. Let's look to go forward with it. So using the fundamental and technical will also be important. That will naturally help with any form of strategic planning that we'll be doing. But let's move on to quickly just the policy implications. Now, economic calendars are essential not only for investors, traders, but also policymakers, government agencies, as a lot of their decisions will be based on which way the economy is going. Okay, if you look at any form of central bank interest rate decisions, you will notice that they have a heavy weighting naturally on inflation, naturally. Okay, they do ideally like inflation down to the 2 to 3% mark. That's where they feel comfortable, and that's when interest rates are more than likely to come down. Probably never to the lows that we've seen, post, '09, '08, '09, '10 recession. But you know, those are the decisions we will look for. So inflationary data, jobs data. So if more people are being employed, more taxes the government is, collecting. It provides a lot more stability and help, which is important. So all those decisions will be, very heavily influenced by the data that is being released. So uh, as a summary, when you are a broker, you want to be speaking to your client, you want to be looking at data, you want to anticipate market movements, you want to use data to manage volatility. It will help with decision making and strategic planning. Are you looking to invest in the long term? What does the data look like? How do the economies look in the long term? Okay, market analysis is important when you are speaking to clients, even though they haven't opened an account and they are looking to potentially come on board. You always got to keep informed. You always got to be picking up the phone, speaking to these prospects and making them aware of what data's come out, how that data has been digested, and what are the potential trades on the back of that data. Okay, as I always say, don't just talk about data and just reel it off. They can easily read the news, but they need to know how you are digesting it and what you can do based off that data. Okay, and if we are talking about forward guidance, just say, look, a lot of the policymakers, a lot of the central bank heads are going to be looking at inflationary figure. They are looking at consumer confidence. They are looking at retail sales. They are looking at, employment figures, as that will give them the understanding of which way the economy is going. And if the economy is improving and it's in a healthy state, they are more than likely to lower interest rates, help borrowers, and be in a position where they can stimulate the overall economy. So those are a lot of the key reasons why economic calendars are significant. Okay, now we're going to start looking into individual data and the significance it has. Again, I've probably highlighted 5 to 7 pieces of data. There will be a lot more, but I'm focusing very much on just market sensitive data, in essence the red box data, and this will naturally help you build a better picture of the sort of data that's being released and understand what it really means. Okay, so when we're focusing on the Purchases Managers Index, or the PMI, it is classed as a leading indicator. It does give you a good understanding of the economic health of an economy, because it does provide early insights into changes within business conditions. Okay, so when we talk about purchasing managers, these individuals are involved in the early stages of the supply chain. Okay, so they're in essence pretty much on the ground, and they got a lot of the key information by way of data, price, supply, and so forth. Now, a PMI will have more of a significance in certain areas than others. Okay, such as the US and China. They're big manufacturers out there, big services output as well. Here in the UK, we're not a big manufacturer, so the PMI data, especially if it's manufacturing PM data, not going to have the same sort of global impact. We are a services-led economy, and there is, services PMI figures as well that is released. So just understand which area of the world, and that goes with all the data we're going to be looking at. The US and China naturally will have their data figures will have the most impact globally, and that's hence the reason why we take a lot more note of it. So global impact is an important one. So as I mentioned, there are two forms. You've got the manufacturing PMI, and then you've got the service. So when we talk about manufacturing, this solely focuses on the manufacturing sector, provides a good insight into many factors such as new orders, production levels, inventory, supplier deliveries, as well as employment conditions within the manufacturing industry. Then you got the services PMI. So unlike manufacturing, the services PMI will focus very much on the services sector. So that will include industries within finance, healthcare, education, retail, as well as hospitality. Okay, so it does focus on factors such as business activity, new orders, employment, as well as any form of expectations within the services industry. You will get this within certain regions. You will have a composite PMI. This version does actually combine both the manufacturing and the services PMI to give you a far broader view of overall economic activity. So it's often considered the more comprehensive indicator of economic health, as it does capture trends in both the manufacturing and the services sector. So when we talk about the actual overall survey, okay, it took me a while just to understand what it really meant, when I was starting out. But in light of the fact it's a monthly survey, it's typically sent to purchasing managers, and they tend to be within the procurement sector or procurement level of the organization. But they send the survey naturally across a range of industries and sectors and geographic regions, as we've just seen, as they will provide you with a good understanding of, the multitude of factors that we've been looking at. So the key part I want you to focus on is obviously the final figure. But if you are looking to break it down in a lot more detail, purchasing managers are professionals within the company. They are responsible for overseeing predominantly the procurement process. So they play a crucial role within the supply chain management of a company. So it's not like just sending the survey out to, anyone, which is not at that sort of level. Okay. Now, when it comes to interpreting PMI, it can be interpreted in a number of ways. The hard fast rule is when we talk about expansion, the PMI will have levels above 50. Okay, 50. That indicates that the sector is expanding, and higher values often suggest strong growth. So if you've got a PMI consistently over 50, that's brilliant. Okay. Conversely, if you got a PMI which is below 50, indicates that the manufacturing sector, for example, is contracting, and there could be a potential decline. Okay, and within the economy, and in turn spread on to investors. But the hard fact about it is, and this goes with everything we're going to discuss, there's no such thing as just because it's above 50 or below 50. You will naturally notice with every economic calendar, there will always be a last month figure, an expected or forecast figure, and then the actual. Really, we tend to focus on actual outstripping forecast. That is naturally a good understanding of growth to a certain degree. Okay, you could have PMI figures expected at 52, for example, and then the actual figure is 51.5. Now, yes, it's above 50, but it hasn't met expectations. It's not where they expected it to be, and that will still have a negative impact potentially on the stock market and the overall market. Investors may think, what, this is the start of a decline. Let's start profit taking. Let's start putting shorts into place. Let's start selling currency, for example. So always remember, actual has to outstrip forecast, actual greater than forecast. That is normally the best way we gauge if that data is good or not. So whenever you're speaking to a client, you just say, look, so we've just had the manufacturing PMIs come out of the US. They have the ISM manufacturing figure. When they talk about ISM or ZEW over in Germany, these are just the organizations which conduct the survey. Okay, it's not a special organization, it's just the certain organization which focuses on connecting the data. So let's say we have ISM manufacturing figure out of the US. It came in considerably better than expected. We were forecasting, 52.4, but in fact we got 53.2, which shows a significant increase within the manufacturing sector, which has spurred investors on, and in turn we have seen the S&P maybe up 0.5%, FTSE's come in tow, and that's up over 0.5% as well. Okay, that data being alone compared to the previous 3 months set of data, we've always seen manufacturing and services PMI outstrip forecast. That could indicate a significant level of growth within the economy, which could indicate the markets could potentially not rally that bit further. In turn, we could be in a position where we could get some longs on. We could look to buy solid equities. We could look to get involved in maybe a S&P tracker ETF. The options will be then available on the table. On the flip side of that, if we've got expected data was 51 and the actual figure was 50.1, is considerably worse than expected. There's a strong chance if it's a US figure, the dollar will get sold into, and sterling and euro, for example, will strengthen against it. So that's the way a trader and currency traders will look at it. But if the figure, and looking at other data around it, it could be employment, it could be GDP, it could be inflation, that could indicate, this economy is maybe not performing as well as we expect. Maybe we should look to profit take, maybe we should look to get involved. These are the sort of conversation you should be having with your prospects and your existing clients. And again, it's just one set of data. We're not suggesting you react on one set of data. It will naturally have to be a combination of all factors before you decide to say, we're going to go long, we're going to go short. But these are the components you would naturally want to look into. You will get two different versions of PMI. You will get the flash and the final PMI. So when we talk about the flash PMI, it's just an early estimate. Okay, it's released probably about a week before the final PMI figures have come out. It's based on a smaller basket of the survey, so it's not taking into account all sectors and all managers. It's just purely a sample size. Okay, but that sample size can give you a precursor for what's potentially going to be coming out. Then the final PMI is released later in the month, usually a week or two after, depending on which region you are in. It is a more comprehensive survey. It is conducted over a longer period of time. It does include the larger responses, not like a sample. So it does provide more of an accurate and detailed picture of economic activity within the surveyed sector. So it does incorporate additional data and revisions from the initial one. So not only you and I will look at it, policymakers will often pay very close attention to the final release, as it does offer more of a reliable estimate on which way we believe the current state is and where we believe the trend may be. Okay, the Consumer Price Index, or CPI, is a widely used measure for inflation, as it does track the average change in price of certain goods and services over a period of time. So it does provide us with an insight into the changes not only in the cost of living but also our own purchasing power. Okay, the way I tend to look at it is, if I was able to do my food shop last week and the set 30 number of goods I buy cost £100, that's fine. But if inflation goes up week two, that same amount of goods I would buy now costs me £120. Okay, so my purchasing power has decreased. I'm not able to, well, I am able to purchase the same amount of goods, but it's going to cost me a lot more. So that's just the raw effects of inflation. And anyone of the age of paying bills and purchasing, shopping, will understand how that has affected us over the last number of years. So when we talk about the selection of goods and services, CPI takes into account food, housing, clothing, transportation, healthcare, education, as well as other goods. So it's important to really understand how it goes about, but I will show you how they split the CPI figure up. There are two variations of inflation. You've got headline inflation and you've got core inflation. Headline inflation includes pretty much all certain goods and services. But when we talk about core inflation, this excludes volatile items such as food and energy prices. So core inflation provides somewhat of a more stable measure of the underlying inflationary trends. Okay, so when we talk about high and low CPI data, remember each country is going to be completely different. Here in the UK, ideally we like CPI figures to be in the region of 2%. That can vary region on region, so it's important to understand which country you're looking at and understand their data. So when we talk about high CPI data, that just suggests there's increasing inflationary pressure, which can really impact investors' expectations about future interest rates and monetary policies. Okay, investors naturally will anticipate central banks to respond with, to higher inflation by tightening monetary policy, and that will lead to interest rates going up in order to cool down purchasing power, stop you going to the shops, stop you buying houses, in order just to cool down the overall economy. Okay, as anyone that's been studying the market over the last number of years would have known, since the pandemic, we naturally went into a global inflationary stage, and globally we've had interest rates up in order to cool purchasing power, and that naturally has brought inflation down. When we talk about the impact on bonds, rising inflation expectations will lead to higher bond yields. What tends to happen is if interest rates go up, the newly issued bonds are going to look more appealing than the ones that you would have purchased a year or so back. So what they do with a lot of those bonds is they lower their prices in order to make their yield to return that bit more effective. So that's one thing to keep a very close eye on. If interest rates go out, the bonds which are issued as of now will be a lot more appealing. Another way is, when you are speaking to clients, maybe make them aware of the inflation data and how they can adjust their portfolio. Okay, investors may adjust their portfolios to favor assets that perform well during periods of high inflation. That could be focusing on the commodity sector, such as gold. So you can either look to buy the physical gold, you can look to buy gold ETFs. During the last year or so, when we've had inflation at its highest, we've seen gold also at its all-time highs. It hasn't actually cooled down quite a lot. The price, I believe, is as of when this video is made, is just close to the $2,000 a troy ounce mark. Okay, the energy prices and energy companies are still going to be performing well in this cost of living phase. When we talk about low CPI data, this will indicate perhaps a weak inflationary pressure, signaling a very subdued, very weak economic growth. Not always the case, but in an extreme scenario it can. Investors may interpret low inflation as a sign of weak consumer demand. Not a lot of people are out there shopping. Not a lot of them are spending their money, which can really impact corporate earnings and economic prospects, which could potentially drag down the economy. That is in the extreme circumstance. So when we do see lower inflationary data, investors naturally will start to see central banks maybe not necessarily drop interest rates to a incredibly low level, but maybe maintain them at pretty stable levels in order to really stimulate the economy, stimulate spending, so we can start to see the businesses perform well. And this can actually support bond prices, which potentially could lead to lower bond yields. So that's one thing to keep a very close eye on. Safe havens. Now, during periods of low inflation or deflation, investors may seek safe haven assets such as bonds or certain corporate bonds. Remember, if if we are experiencing low inflation, low consumer confidence, low consumer spending, and we're seeing businesses start to struggle, we could see an economic pullback. Okay, investors could start to drag their money out of the stock market. And what tends to happen is you rather than lock your money away in an area where you're guaranteed income, especially if we're talking AAA government bonds, is seen as a safe haven just in case we see market instability. Okay. Outside of that, commodity prices, we have touched on it, but commodities tend to do very well, gold in particular, during periods of inflation. And I'm pretty sure a lot of investors are clued up. So the way we tend to look at it is anytime you see the inflationary data come out, match it with what the actual expectation is. If we are starting to see inflation go back up, we need to make our clients fully aware that interest rates could go up in order to cool down the overall economy. But if we are starting to see inflation come down to a more stable level between the 2 to the 3% here in the UK, interest rates are more than likely to stay stable, if not get a lot lower, in order to continue to reward businesses and get you out there and spending. And if that is going to be the case, we tend to see rallies within the overall market. So we prefer inflation being low, we prefer interest rates being low, and that tends to lead to more risk on and strategies favoring a more bull market. Okay, now we're going to take a look into housing data. I believe one of the more significant statistics and data that we naturally have to look into, along with employment. I've got two here. I've got housing starts, so I've got building permits. They are both separate figures, but in essence we need both of those to be increasing month on month. But one thing you will know, with a lot of the data that's released, even though it's released monthly, it's an annualized figure. Okay, so it's not based on a previous month or so forth. So it is an annual figure which they just update every month. So do very much bear that in mind. But when we talk about housing data overall, it's a big indicator of economic activity and health for the housing market. An increase in either of these suggests growing demand for housing, reflects a lot of optimism amongst builders as well as developers, about the future market conditions, and in turn investors or individuals purchasing homes on a daily, weekly basis. It just shows a lot more growth within the economy. Conversely, the other way around, if we do see weak numbers by way of properties being constructed or permits being given or people buying houses, it could lead to a contraction. Contraction leads to potential recessions. Recessions lead to market pullback. So that's one thing we've got to bear in mind when we're trying to bring this information over to our investors and prospective clients. But let's break them both down individually. When we talk about housing starts, this refers to the number of new residential projects that are actually in the process of being built. It's over a specific period. Like I said, it's going to be annually. With a lot of the data we look at, it's all annual based. So remember, housing starts, these are construction projects which have already begun. And by the name, when we talk about building permits, this refers to the number of permits issued by local authorities, and they give permission to start construction on new residential buildings. Okay, now the reason why many people believe building permits is the more significant data figure. By the way, building permits is a leading indicator. Housing starts is a coincident indicator. So building permits tend to be a more significant figure based on the fact that when these permissions are given, there is some form of indication of where they see the economy being in 12 months time. So if I'll be prepared to start a new project because I believe everything's going to be good in the next 12 months. So that tends to be a good indication. They believe that there will be momentum moving forward. So those are the two different figures, remember. So keep a very close eye out for both. When we talk about, what we can read into the figures, economic growth is something I've just mentioned, but when you're speaking to an investor and they're not sure about the market, they're not sure which way, whether they should be, getting involved now or waiting, you want to be backing up your reasoning for them to open an account and get funds on board based on the fact that, look, sir, ma'am, we've had, strong housing starts, strong building permit figures, not only here in the UK, but also in the US, is showing a global economic recovery. Back it up with other data. We have seen CPI inflationary data drop. It's come down to the pre-agreed levels that central banks, predominantly here in the UK, are happy with. That tends to lead to interest rates becoming a bit lower in the months to come. That will ignite investor confidence, and in turn we could see the market propel further. We've already hit all-time highs, and that's in relation to inflation being at an all-time high. So sentiment is still there, definitely not overcooling. So these are the reasons for investors to say, you know what, you're right, maybe I should look to get back involved. There are other figures that you can look into. Mortgage approvals are again another figure that comes up quite often. More mortgages being approved, the better. And especially in today's day and age, it's different from 08, 09, 010, predominantly in the US, where anyone that wanted a mortgage, 100% mortgages were given, even though very little checks were done. A lot of those people tended to default. So mortgages that are approved nowadays are very heavily vetted. So the figure tends to be very good. More people have enough money for their deposits to get mortgages, happy to jump on the property ladder. That has natural knock-on effects which are positive. Existing home sales, that just in essence tracks the number of existing and newly constructed homes that have been sold over a specific period of time. Can be a year, can be a month, depending on what data you look at. You will sometimes see M/M, so that's a month-on-month figure. And then you can have a Y&Y, which is a year-on-year figure. So do keep a close eye out for both those. You will have pending home sales. These are existing home sales, but this is where the contracts have actually been signed. Agreements are in place, but keys just haven't been transferred yet. So they're in the process of completing. And finally, you will get home prices. When we talk about home prices, we tend to look for the trends, as that gives us a good indication of if we're trying to see any form of asset price bubbles. Are we starting to see the sector overheating? And in turn, that's when central banks can intervene. Because the last thing we need is property prices rallying. Not a lot of people, especially not a lot of entry-level people, able to afford them. That will have a big ramification moving forward. And consumer confidence. Look, anytime data, it's not just housing data. Anytime data in general is good, consumer confidence is high. It does indicate a lot of optimism. It does lead to increased consumer spending and investment. So these are the factors we want to look into. That has a knock-on effect to investor outlook and investor confidence. Not just housing, once again, any other form of data. We will start to see investors look to get back involved in the market, look to diversify. A lot of people may then want to purchase stocks within just the construction sector. They might want to look at the likes of Taylor Wimpey, Barratt Developments. They may want to look at real estate investment trust, predominantly found in the FTSE 250, or they may want to look for ETFs. You can have a real estate investment trust via an ETF. So there's all these different ways of investing and really taking advantage of the data. So not only just using it as a generic economy-based data, use it as sector data. Maybe I should start investing more and diversifying more into construction as well as property investments. And then finally, you will have monetary and fiscal policies. So whenever we're talking about monetary policies, if, for example, we start to see robust growth in the housing market, central banks will always, keep a very close eye out, as it could give signs of an overheating economy, overheating sector, or as mentioned, asset bubbles. So they may have to consider tightening monetary policy by raising interest rates, to prevent any form of excessive borrowing or any form of speculative behavior. or one of the biggest factors is inflationary pressure. So they just try cooling down the overall sector as a whole. And then finally, when it comes to fiscal for me will mainly be the jobs that have been created. It will contribute towards economic growth, but more importantly, the taxes that the government's in the position of taking. Because when we look at properties being built, big high rises, big constructions, obviously more people are paying taxes as they're working, but construction leads to many other factors. It's not just people on the site, it's also the suppliers of all the raw materials, people that fit bathrooms or the electricals. It has a knock-on effect to multiple different sectors, and actually offers stimulus to all these other sectors. So that's naturally why housing data is important. So please really try looking at it, understanding it. Look at the previous months. Are we starting to see a massive uptick in new construction, new permits? And that will normally give you a good indication of if the economy is improving or not. Okay, now we're going to take a look at PPI, Producer Price Index. When we talk about PPI figures, this is the change in the price of finished goods and services sold by producers. It does exclude, food and energy. When we look at a PPI, in its core nature, it's an inflationary-based figure. Okay, very similar to CPI. They are used in conjunction with one another. The big difference is when we talk about the PPI as an inflationary indicator, it's more really looking at the producer level. How has the price changed at a producer level? So that includes all the raw materials that are involved, all the costs involved at an early stage to bring it up to a finished product. What is the inflationary pressure within the production process? As we do know, if there is a huge amount of inflation at an early stage, even purchasing the raw materials, we know for a fact that the back end product is going to be that bit harder. So it allows policymakers, investors, businesses really assess the pressure producers are under, analyze the profit margin, and more importantly, anticipate any potential changes in consumer prices down the line. So that tends to be one of the main focuses for PPI. Cost pressure is, the end product. So whenever you hear cost pressures and CPI and PPI, a lot of that will come down to the impact on profit margins for businesses. Okay, investors will analyze PPI data to assess how much cost pressure will be faced by companies, and what is their ability to pass on those higher costs to the consumer. Now, just because something costs a lot to produce, it doesn't mean you can necessarily increase the prices and remain competitive. Unfortunately, that's not how it works. So what will tend to happen is if the end product is more expensive than something you can buy abroad, you're more than likely to buy something abroad. Okay, by you doing so, though, it's putting a lot of pressure on local businesses. They're struggling to survive because they naturally have to pass the costs on to the consumers. But if the consumers don't want to buy that elevated cost, they start to struggle, they start to go under, and then business sentiment is negative. If that happens, throughout the region, you could start to see recessions, especially if we're purchasing our goods from abroad. So that's naturally why you do tend to see governments, really focus on, buying from home, buying from your local high street, buying from your local producers. It keeps them very much in business, and they can contribute towards the UK economy. But if you're buying your goods from, all the major supermarkets from abroad, it will put a lot of cost pressure on not only businesses but the overall economy as well. When we look at the overall economic conditions, PPI data does provide insight into economic conditions and activities within various sectors of the economy. So changes in producer prices, as mentioned in my previous point, will reflect shifts in demand, supply chain disruptions, or other factors that will affect production and pricing decisions. So investors will analyze the PPI data along with other indicators, as I will continue to keep mentioning. This is not a standalone figure. CPI is not a standalone figure. You need others to really assess the health and the direction of the overall economy. It will give you an understanding and identify potential investment opportunities and allow you to make a lot more informed decisions. When it comes to monetary policy decisions, central banks use the data just like we do to formulate any form of decisions, whether that be setting interest rates, adjusting policy measures in order to achieve their inflation targets, whether that's to bring it down or rise it. So yeah, rising PPI may prompt central banks to tighten monetary policy, just like what CPI will do. Now, if we were to look at CPI and PPI and just really understand the differences, so just to recap, CPI measures the average change over a specific period in time. These are the prices paid by consumers for a basket of goods and services, food, housing, and so forth. Okay, so it just really reflects the overall living costs of an individual. But when we talk about PPI, these are in essence the raw costs involved in producing a certain product, the early stages of a product. So the cost of raw materials and so forth. So one being an end product, one really taking into account the inflationary pressures early on. So whenever you're speaking to investors and your clients, always make them aware of not just CPI data, look at the PPI data, use both of those hand in hand to formulate whether inflation will be where it is or if it's looking to tick higher. If inflation ticks higher, you know for a fact that central banks will look to tighten their policy, which will mean increasing interest rates in order to cool down spending and overall bring prices that bit lower. Okay, now we're going to focus on non-farm payroll figures, employment data in general. When we talk about non-farm payroll figures, this is predominantly a US-based figure, but employment data from significant regions is important, whether that's UK, Germany, China, so on and so forth. So it's important to really assess the number of jobs that have been created or lost, throughout the previous month. As we will always know, the more jobs created, the more taxes being collected, the more the government has to spend by way of infrastructure expenditure, housing, homes, or NHS and so forth. But the flip side of that is, with more jobs being created, the more money individuals have. More money individuals have means more money being spent in the shops, more housing being bought. And remember, everything you buy, everything you spend is always taxed as well. So it's just a way for the governments, to collect as much money as possible. But with the phrasing non-farm, in essence, it takes into account every sort of job being created or lost, but it does not include agricultural, government, or private household jobs. That's what they mean when they say about non-farm payroll figures. Now, everyone will tend to look at this figure, whether you're an individual investor, whether you're a policymaker, or just an analyst. Okay, the markets usually stand still up until 1:30, 2:30, depending on daylight savings, on when this data comes out. Then the markets react. Currency markets react very rapidly. It's always issued on the first Friday of each month. Okay, never changes. Always on the first Friday of each month. Now, what can we read from the report? Apart from the number of jobs created and lost, it will give us a good indication, as mentioned earlier, as the overall health and the dynamics of a labor market and the overall economy as a whole. Now, when we talk about economic health, this is the key part when you are speaking to investors. It's one of the key figures. This really determines if we're heading into not the single most, but it is a strong indication of if we're heading into a recession or not. So whenever you're speaking to a client, always keep them updated with what happened with employment data, not only from the US, but also from the UK. Does it spell a good indicator of overall economic health? You know, that will be down to yourself. You know, a strong job creation typically does create a healthy and growing economy. So that's one thing we want to focus on. Consumer spending. You know, high levels of employment and wage growth generally lead to increased spending and confidence. People have more disposable income that can boost a lot of confidence and spending on goods and services, luxury goods and services. But job losses and a stagnant wage growth will obviously dampen consumer sentiment and lead to reduced spending. Reduced spending can send the economy into a spiral on the downside. Interest rates and other monetary policy decisions. You know, central banks will closely monitor this and assess the current economic condition, as well as looking at a wave of other data, of course. If, for example, more people are losing their job month after month, and consumer confidence and spending is low, business sentiment is low, central banks may want to reignite the economy by looking to lower interest rates. Lowering interest rates will make it easier to borrow. It will make it easier, to pay bills, and in turn, you'll have enough. You'll have a bit more money in your pocket to start spending and getting going as well. Outside of that, stock market performance. Naturally, we wait. Every first Friday of every month, we take a big note out of what comes. Of course, you got to read the data in its entirety. Just because non-farm data came in better than expected, a lot of jobs were created. But if your hourly average wage growth is not that much, that's going to also be a concern. And if, for example, there's other factors, such as elections coming, crises in whether it be the Middle East or Russia, Ukraine, it can still be a dampener. So sometimes you've got to take certain things with a pinch of salt. Unfortunately, everything is not black and white. Everything is not as it's read on the paper. You've also at times got to read in between the lines. So when you are speaking to investors, be fully aware that you're not just going in, oh wow, non-farms are great, let's keep buying. Make them fully aware of, look, yes, non-farms came in considerably better than expected, but we are still that bit cautious based on events not only globally but also by way of other data that is being released. So say, look, we can take very much of a hedging position. We can look to still invest in slightly lower beta stocks. We may want to scale down certain positions that we are in. There's multiple different options investors can go into. Currency market, forex traders, love data releases. Um, they tend to react very quickly, whether they choose to, buy the dollar or sell the dollar. If the non-farmed is great, you naturally see dollars strengthen against all major currency pairs. If it's not that great, you see other currencies strengthen against the dollar. So it is somewhat of an easy trade, but literally once the information's out, the move's already happened. So it's very difficult to take advantage and benefit from the full move. Government policy and expectations, as we know, governments use employment figures as a gauge of their own economic performance. They do adjust policies in accordance. If more people are being employed, is great. They may have more expansion plans. They may look to, focus a lot more on infrastructure. It will help anyone that's, going for election, or anyone that's in power. They can justify whatever actions they have done has led to job creation, which tend to lead to, a strengthening economy. So these are factors we want to take into look for the political angle as well. Trading opportunities, as mentioned, opportunities for traders across various classes, whether you're stocks, bonds, currencies, commodities, there's always an opportunity. But be fully aware, if markets are very much risk on, if markets are, very buoyant, bonds are not a area of investment that you would want to focus on. Why take, 1.5%, 2%, 3% from a bond where you're involved or you've invested in a bond and you get that much yield, when you can get 8% growth just in the FTSE 100, or you can buy stocks which are providing 6, 7, 5% dividends consistently. Okay, so instead of locking your money away in bonds, you can keep it very much active in the markets. Stocks, if the market's rallying, do you want to be involved in low beta stocks? Do you want to be in defensive stocks, or do you want to be involved in stocks that tend to enjoy market rally, enjoy risk? High beta stocks, banking, mining, energy, they do very well in these sort of market conditions. Again, you may also want to adjust your trading strategy if the data is somewhat stagnant month on month. Yes, jobs are being created, but not at a rapid rate. You still may want to take a balanced approach. It could be a case of a straw that broke the camel's back. There could be data around the corner where investor sentiment weighs a bit. They said, you know what, we've had a great rally in the markets, but maybe the sentiment's not there. Everything may be overpriced. All these factors you may want to take into consideration. But yeah, non-farms are arguably the single most important piece of data that is out there. So yeah, please take note of it, and please apply it when speaking to investors. Okay, unemployment claims. I think with the name, everyone is very familiar with this form of data. Again, it refers to the number of individuals who have filed for unemployment benefits with the government during a certain period of time. It is usually a month. It is a lagging indicator. So whenever you see the data and they say maybe 100,000 people claimed unemployment, it's a last month's figure. Okay, so always bear that in mind. We always look at unemployment claims and other forms of employment data as working hand in hand. It's very important. It is a key indicator of gauging overall economic health, as well as understanding the overall direction, as it does give us an understanding of the amount of people that are being laid off or are struggling to find roles. Now, whenever we look at this data, we always put it into perspective. More people claiming unemployment means that the government is spending more money on benefits. The more money government spends on benefits, the less money it has coming in. Okay, and in turn, less money for infrastructure projects or NHS, hospitals, wherever it be, right? So if you look at that, that could potentially lead to recessions, downfalls in markets, and less spending elsewhere. Okay, so it could lead to overall contraction. Now we're going to take a look at some of the reasons, why claims may go up and down. Okay, economic conditions. So during periods of recessions or contraction, companies naturally have to get rid of their biggest expense, and unfortunately, that is their employees. They will reduce their workforce through layoffs or downsizing, leading to an increased amount of unemployment claims. Okay, but again, during periods of expansion, companies will look to hire workers, and it will reduce the number of individuals claiming benefits. So ideally, whenever we are seeing a rallying market, more jobs are being created, more people coming off benefits is ideal. But be fully aware, if in the future you do feel that the economy is contracting and you do feel that we are coming into certain headwind in the next 6 to 12 months, be fully aware, make your clients aware, look, unemployment claims could go up. Employment levels will naturally not be as high as they usually are, which could lead to contraction. We may want to take more of a passive approach with our portfolio, focus more on defensive companies. Okay, the next one will be seasonal factors. Okay, certain industries and sectors will experience seasonal fluctuations in employment due to many factors. It could be holidays, it could be weather, changes in demand. So if we look at the construction and retail sector, they tend to see more layoffs during the winter months, while hiring will naturally tend to pick up in the holiday seasons around Christmas and so forth. You will naturally tend to see, in order to meet demand, stores will stay open longer. And obviously during periods where, the days are longer, construction tends to be, a quite worthwhile industry to be in. The next one we will look at is cyclical industries. Okay, these are industries that are more sensitive to economic cycles, predominantly manufacturing and construction. So they tend to experience more fluctuations in employment levels based on demand for their product or service. So any form of economic downturn can lead to a lot of layoffs, as well as increased unemployment claims, whilst naturally, as you're well aware, if the economy does pick up, these industries tend to do very well. Structural changes. Okay, now whenever we talk about structural changes, this is areas such as technological advancements, shifts in consumer preferences. It can really impact employment patterns and lead to changes in unemployment claims. You naturally see a lot of companies being more online. Okay, everything is being shifted away from the high street to online, and that does tend to have a big impact on company structures. It does tend to lead to more layoffs. So it's interesting to see which way we will see the future going. Is everything going to be tech based? Are we going to see everything very much online? Is everything going to be a lot more streamlined? So that could lead to areas. So always be in a position where you can find any form of opportunity. Are there certain sectors which you feel are doing well, certain sectors that are good for the near term or the future? Those are areas you may want to look at. And finally, government policies. Changing in government policies, can have a big impact. That can be regulation changes, any form of fiscal stimulus measures that can influence the number of jobs being created or layoffs being taken. So if we take an example, extensions of unemployment benefits during economic downturns could lead to an increased amount of claims, whilst changes in eligibility criteria may also affect the number of claims. So there are a number of factors that you would have to take into account to justify the number that we will get. But all in all, when we speak to our clients, just make them aware of what the actual number is and the reasons behind it. It could be based on current economic climate. It could be a seasonal factor. It could be down to certain industries experiencing changes. It could be structural changes. There could be a shift in dynamics. Everyone's not opening up as many stores. Everyone's going very much online, and that goes for any industry. And there also could be government policies which could affect the number of people claiming unemployment. So always keep an eye out for all factors. Okay, looking now at trade balance, also known as balance of trade. This is the difference between what a country exports, so sells to other countries, and what it actually imports, buys from other countries. Okay, so if a country exports more than it imports, that country has a trade surplus. This is a positive trade balance. In other words, a country is selling more goods and services to other countries than it is actually buying from them. Okay, so a trade surplus can result from many different factors, including having a competitive advantage in certain industries. There could be high demand for domestically produced goods and services, or it could be based around just having a very attractive exchange rate. Okay, so that's what we class as a trade surplus. And if a country is in a trade surplus, their currency naturally tends to be very strong, as you are buying majority of your goods in that currency, and they tend to have lower external debt levels. Okay, but on the flip side of that, if a country is importing more than it exports, it is classed as having a trade deficit. This is a negative trade balance. So in other words, a country is buying more goods and services from other countries than it is actually selling to them. It's spending more money buying from other countries than it is earning by selling to them. Okay, so if a country buys £200 million worth of raw materials from one country, okay, but it's only selling £150 million worth of their own goods, it is in a trade deficit of about £50 million. Okay, so countries with a trade deficit, tend to borrow more from abroad to finance their um, excess imports. Okay, it leads to further debt and a lot of downward pressure on the country's currency. Okay, so this could lead to it having a very poor competitive advantage or not even being competitive at all. Okay, and if you are importing more than exporting, you are reliant on other countries in order to bring in your goods. This can have a massive impact on domestically produced products and smaller businesses as a whole. So naturally, that's why you want to have somewhat of a trade balance where I'm happy to buy from you, you buy from me. So domestically produced manufacturers or services are able to have a bigger marketplace to actually sell their goods. Okay, and just to break it down that bit further, what does a trade balance show us? So whenever you look at that figure, what does it show us? One, it could mean economic competitiveness. Okay, if there is a positive trade balance or a surplus, it indicates that the country, as we know, is exporting more goods and services than it is importing. Okay, this suggests that the country's industries have a competitive advantage internationally. That could be based on the fact that you are producing goods and services that are high in demand. That could be raw materials, it could be fabrics, it could be metals, it could be energy. Conversely, if you have a negative trade balance, this suggests that the country, as we know, is importing more than it is exporting, and is showing that it's having a lot of challenges being competitive, or any sort of you know um, never able to get a foothold, let's put it that way, and that can actually have massive ramifications on it being competitive as a whole. Breaking down strength of industries. Okay, trade balance is not just a one figure that this will tell us everything we know. We can actually break it down that bit further. So if a country's trade balance is, for example, positive, they are in a surplus, it could mean that certain sectors such as manufacturing and technology are doing very well. They've got the advantage internationally by way of, everyone coming to them to buy all their goods. But they could also show certain weaknesses in other areas. Maybe there's services, or maybe there are other areas in manufacturing which are not being bought as actively, and in turn we're having to buy from another country. So the strength of industry is important. The trade balance will show us what areas are doing well, what are people buying from us the most, which is great, and what areas are they not buying from us the most. Okay, where are we more reliant? Why do we have to go to X, Y, Z in order to purchase certain things, and we are not able to produce it ourselves? So that's one way of really breaking down a trade balance. The impact on GDP is important, and I think it goes hand in hand with anything really. So any trade balance will affect GDP as a whole. Surplus will naturally contribute positively towards GDP growth, as exports are counted as part of the GDP figure. But again, if we get a trade deficit, that does detract from the GDP growth. So that's one way of seeing if the economy is growing or not. Currency strength is important. Any form of trade surplus tends to strengthen a country's currency, as foreign buyers need to exchange their currency for the country's currency in order to purchase their exports. Conversely, any form of deficit will weaken the currency. A lot of trade is naturally done in dollars, and no matter what country you are in, they will naturally have dollar reserves as well. So that could be one aspect of looking at it. There are other forms of external debt and financing. Like, if you are consistently in a trade deficit, it could lead to an accumulation of external debt, as the country will need to borrow from abroad to finance a lot of its imports. Okay, so monitoring the trade balance is important for assessing a country's external finance needs, as well as understanding their vulnerability in certain areas. One way of looking at the trade balance is to look at potential trade wars. They are very common. If you've been keeping an eye on the news over the last number of years, let alone Brexit, there's been agreements or disagreements with the likes of US, China, and so forth. So when we talk about a trade war, in essence, it is a situation in which a country will start imposing tariffs, trade barriers, or other restrictions on each other's imports and exports in an attempt to really protect domestic industries. And so they're just trying to address any form of imbalances, or maybe even trying to gain a competitive advantage in international trade. So trade wars typically escalate when one country imposes tariffs on another. It's like me saying, look, let's say I'm one country and there's another country. I'm buying 80% of my machinery from this country, and they're only buying 10% of my machinery for their country. Okay, so there's a big imbalance, and I go back and I say, listen, you should stop. I'm buying all these things from you. You should start buying some stuff off me. And if they don't want to do that, then I will say, fine. Anyone that wants to buy from that country, I'm going to make it difficult for them to buy. I'm going to place tariffs. Okay, and it means that if you want to buy, if any of the domestic businesses want to buy from that country, they will now have to pay an inflated charge. Okay, so it becomes more expensive for businesses to buy from that region. So they would say, you know what, instead of us buying from that region, let's maybe try buying domestically, and then we start growing the economy internally once again. Okay, so that's one way of trade wars really having a massive impact. But the likes of the US and China and US are so large, they can actually write whatever trade agreements they want, and a lot of parties naturally have to go by what they say. So yeah, those are trade wars. They are common. There are always restrictions to trade, no matter where you look. Tariffs are a big part of any form of trade balance within certain regions. So take on board all this information. Understand if the country you're in is in a trade surplus, trade deficit. How severe is it? Don't get me wrong, being in a deficit is not a bad thing. Majority of the countries tend to be in deficits anyway. It's just how extreme it is. What are the levels of debt like? Are there any upcoming trade agreements? And those sort of things will stimulate overall growth, and it could lead to positivity in markets. So yeah, keep a very close eye out on that. Okay, with interest rate decision and announcements, they are seen as a significant event when it comes to looking at the economic calendar. These events provide an insight into the monetary policy actions of central banks, and in turn their implications for the financial markets and overall economy. So central banks, whether it be the ECB, Bank of England, or the Fed over in the US, they will use these changes in the official rate to achieve whatever objective that could be controlling inflation, that could be promoting economic growth, or merely just to stabilize the currency of that nation. Okay, so when we look at the effects of rising, let's start with rising. So when central banks raise interest rates, borrowing becomes more expensive, which tends to reduce consumer spending and business investment. This is predominantly designed to cool down inflation, especially if inflationary pressure is quite high, like we've seen over the last number of years. Now, the central bank may raise interest rates to moderate growth and prevent the economy from overheating. Okay, so higher interest rates can help slow down consumption as well as investment. Okay, leading to more sustainable pace of economic expansion. Okay, as well as in periods of excessive risk taking or asset price bubbles, such as housing or in the financial markets, central banks will look to raise interest rates, really tighten monetary conditions, and reduce the risk of financial instability. As we know, with asset price bubbles, they can burst, and that can lead to a free fall in the markets. Okay, so yeah, those tend to be the key reasons why interest rates would be increased. So on the flip side, central banks will look to lower the bank rate, allowing borrowing to become a lot more cheaper. It stimulates consumer spending as well as business investment. So lowering interest rates can help spur economic growth and support employment. Okay, so if we look on the opposite side of inflation, if inflation is sometimes too low, especially if it's below 2%, especially here in the UK, and is forecasted to remain incredibly weak, the central bank may lower interest rates in order to stimulate economic activity and in turn get people out there spending, buying houses, going to the shops, and boost inflation. Okay, as we know, lowering interest rates does make borrowing cheaper, so it encourages consumers and businesses to spend and invest more. This naturally will look to help lift demand and prices. Another way is if the economy is experiencing a slowdown or a recession, with high levels of unemployment, weak economic activity, the central bank may lower interest rates to really stimulate that demand, encouraging borrowing and investment and support job creation. Okay, if businesses are finding it easier now to get money from the banks and people are starting to purchase their goods, they will experience an uptick in business, and in turn they may look to start hiring. Okay, during periods of financial stress and market turmoil, the likes of recessions, the central banks may lower interest rates to provide that sort of liquidity to stabilize the financial markets and, more importantly, provide that confidence. Okay, it will help households, and in turn you will tend to see the economies recover. So it's important when you look and you read the news, interest rates is always a big part of investment decisions, people looking and forecasting for the future. Okay, so it's not just the baseline interest rate, it does affect other areas. It affects your mortgage rates, it affects loan rates as well as saving rates as well. Okay, so there are ripple effects when these decisions are identified and released. What else with regards to the central banks? It's important to understand the heads who's in charge of the central banks. A lot of it is not just the policy statement, it's also the press conference you want to keep a very close eye on. So outside of the interest rate decision, central bank heads will often provide, accompanying policy statements, press releases, and that's really there to provide insight into the outlook of the overall economy. Okay, so we do take a lot of note of what individuals are saying, where they see the economy growing, and what their forecast is. They are very transparent. Every central bank is very transparent, so all the information is out there. Over in the US, you got the FOMC. They are the Federal Open Market Committee. Okay, they're in essence the main body who is responsible for formulating the US's monetary policy. Okay, they are there to set targets and provide the decisions on where they feel it could go. Here in the UK, obviously, we've got the Bank of England, and then under the Bank of England or within the Bank of England is the Monetary Policy Committee. This is the body that really is responsible for the decision making and setting the bank rate or the official bank rate. I believe there are 9 members in the MPC, and in the FOMC, I believe there's 11, but possibly please double check that. So yeah, that's the reasons why we should be keeping a very close eye on interest rates when we are speaking to our clients. This is one of the key indicators. And remember, no central bank committee will make any decision unless they are looking at employment figures, unemployment figures. They're looking at CPI and PPI figures. They're also looking at manufacturing PMI, services PMI. So they take into account everything in order to understand which way they feel growth is going, and then they make their decision on the back of it. Are they looking to stimulate the economy so they lower rates, or are they looking to cool down the economy where they increase the rates? Okay, So always try making your clients aware of what the decisions are and where you potentially forecast the markets to be going. Okay, I've put recessions on this module. It's not a case of, you get an official figure on the economic calendar. Recessions are not stated like that, but I think it's worthwhile knowing because all the data that we've looked at and everything you will tend to read does tell us which way an economy is going. And whenever we talk about a recession, it's a significant and widespread decline in economic activity, and it lasts for a certain duration of time, which will naturally vary. It is characterized by a contraction in GDP, okay, and 2 negative quarters of GDP results in a technical recession. In order to get out of a recession, you need 3 positive quarters of GDP, okay, and then you're out. So since 2010, the last real deep recession, we've only experienced another two. Okay, one was during the pandemic, and one was just over a year and a half back now. Okay, and even the last one wasn't a deep recession. Even the one with the pandemic, that was forecasted. We knew that was going to happen. Okay, purely based on the fact that there's rising unemployment, consumer spending would be down, business investment will be down. So recessions are naturally part and parcel of any form of economic cycle. So it's not something new. It's just a case of addressing a recession and ways in which you can benefit from it. Okay, even the last couple of recessions, the markets have done nothing but rally. Okay, so it's not deep enough in order for you to say, okay, fine, we should start taking all our profits or going short. Certain sectors will dip, and certain sectors you can buy from a dip, which are important. But we'll look at how do recessions occur? One is going to be high inflation. I've put inflation because it is a lot more topical in where we are currently in the world. As we know, inflation is when prices of goods and services rise too quickly. Okay, it reduces our overall purchasing power, and in turn, central banks tend to respond by rising interest rates to control inflation to slow down the overall economy. But since inflation is really high, consumers and businesses lose confidence in the overall economy and its stability, so it will cut back on spending and investments. This could lead to very low demand for goods and services, and in turn slow down the overall growth, which could lead to a potential recession. The second one is high interest rates. Now, high interest rates are not an issue. It's prolonged high interest rates, okay? Central banks often raise interest rates to control inflation, but higher borrowing costs can actually discourage investments and consumer spending. And that's one of the big parts, especially in today's, when I'm making this video. Inflation's actually come down to pre-agreed levels around the 2% mark, but interest rates are not coming down. Okay, then you got to listen to what the policymakers say, and whether it's the FOMC, whether it's the Bank of England. It could be a case of, look, we're experiencing or potentially going to experience further headwinds down the road, so that's why we are keeping interest rates the level that they are. But by them doing so, they're not encouraging as much growth as needed, and in turn they're probably going to run into a headwind very quickly and hit a brick wall as the economy may start to struggle. So interest rates are fine going up, but they can't be prolonged, and it's not sustainable for a long duration of time. The next one will be asset bubbles. Sometimes asset bubbles, they can be in the form of the stock market, it could be in the form of real estate. They become overvalued. When these bubbles burst, as we saw in the 08, 09, 010 recession, it can lead to significant financial losses. People will stop spending, and a recession will occur. So it's important to see if there are price bubbles out there, but not really one that we can see. The stock market seems to be evenly priced, so it's hard to say if there's any bubbles on the horizon. Global events, international events such as wars, pandemics, or global trade disruptions can reduce economic activity. And when we talk about global trade disruptions, that is a lot of the time that's based around energy, oil and gas. Okay, and as we saw with the pandemic, global recessions happen due to lockdowns, reduced trade, and massive disruptions in supply chain. So, those are some of the key reasons. And financial crisis is what ensues, or what we saw definitely in '08. If the whole banking and financial sector collapses, it does create panic. It reduces credit availability. You're not able to sometimes get your money out of the banks. That's why you get what we call bank runs. So this happened quite a lot from '08 for a number of years. But those are the main reasons how recessions occur. So it's not only about knowing them, it's about keeping an eye out for what could potentially be in store for us. Okay, the next section is the impact of a recession. Okay, unemployment, I think that's the go-to, as I've mentioned before. When business need to start reducing costs, they tend to go for their staff. So recessions will lead to job losses. Businesses are either looking to reduce their workforce or completely shut down operations. So high unemployment rates will contribute towards a financial hardship for individuals and families, and put a lot more stress on governments, because more government funding will be needed, and more fiscal stimuluses in order to allow for growth. Income and wealth will naturally decline. Many businesses, particularly small, medium-sized businesses, will struggle to survive during a recession. We rely very heavily on consumer demand, but tighter, credit conditions, increased operating costs will make things and life difficult. So some businesses will be forced to close permanently, and that will lead to prolonged job losses and lack of economic output. And finally, government finances. Recessions will put strain on government budgets as tax revenues decline. People are not working, government's not collecting enough taxes. There's going to be more demand for benefits and help with the bills. So even healthcare services will start, suffer massively. So governments may need to borrow more to finance any form of stimulus measures. Okay, and that will lead to higher public debt levels, and eventually they're going to have to pay that back at some point. And by them having to pay it back, taxes will have to be increased at some point. So it can be a never-ending circle, but that is how recessions occur and the effects of it. So it's important to keep a very close eye out. But sometimes you can predict recession. Well, you can't predict them. You can see them coming to a certain degree by looking at all the data that we've gone through, understanding where we are struggling, whether that's via the trade element, whether that's going to be down to unemployment levels, are people hiring, what's our wage growth like. These are factors. If we're starting to see more investors and big investment banks shift their money from the equity markets into bonds, why are they opting for safe havens? It could be the fact that they see something coming down the line. So these are the ways in which you want to explain to your client, and in turn make them aware of how you could potentially go about it, whether that is looking at hedging, index shorts, whether that be looking at more defensive stocks, as a lot of defensive stocks do very well in a recession. High beta companies do not. Okay, you just have to look at over the last, even during the pandemic, there were companies that were doing incredibly well. Majority of the companies obviously weren't doing well on the markets, but overall there will be good defensive solid companies which will stand the test of time. Okay, yeah, so that's all we need to discuss on this point.